Hey, what's up, everyone? Gonna give it another couple of minutes. See if anyone else shows up. We got some more responses, and then I'll get started. All right. I just want to ask: Can anyone? Everyone can type in the chat box, right? Like, can you guys see this message? Yeah. Okay. Cool. 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 Awesome. Okay. So this is my first time doing permissions in Discord. I have no idea how to run a Discord. I know how to trade, so I figured out. I figured out the permissions, so you should be able to type here now. And yeah, we'll get started. I'm gonna record this as well. So if you ask any questions, your voice might be recorded. AJ was like showing me how to do this shit earlier. Yeah, feel free to come off mute if you have any questions. Make it interactive as possible. I usually do these kind of at the end of every interesting PA day, or like every price action day that I find is worth studying. Um, Today was a very interesting day, so let's hop into it. Okay, everyone can see my screen? Yes, it should be good. Choppy day. Absolutely, very choppy day. Okay, let me turn on my audio here as well. So if you want to come off mute as well, you can totally do that. So let's talk about the day, what I saw, and how we can use market maker models to kind of frame some of the price action of the day. So I here have an annotated chart with some stuff. I'm gonna duplicate this and we're gonna look at a blank chart just to start. Okay, let's do that. So, oh yeah, I'm not gonna delete. Instead of duplicating it, I'm just gonna make a copy so it doesn't delete my other stuff. Okay, so let's take a look at this chart, right? And let's make it with nothing. Well, let's blank it out. So moving into today, let's take a look at what I was seeing and kind of what my anticipation for price was. Now, if any of you guys follow any of my kind of announcements or any of the updates I give, I was expecting today to have some sort of run on buy stops. Now, I really wanted to see a higher level of buy stops taken out. Maybe something like up here is what, if you guys look at the ICT profiles that I have, let me go in here, share my screen, and then I was really looking at something like this. Now, this is called the Consolidation Thursday Reversal, and it's typical to observe a weekly profile like this and a daily profile like this when we have expansion Tuesday through Wednesday that creates a low resistance liquidity run, and we have a lower time frame target for the end of the week. Now, as you can see, what I just said, those words, are fairly consistent with what we are observing in price in terms of our draw on liquidity. So if you guys have been following me, you know that I am looking for a 14,586 eventual draw on price, which is going to complete both a weekly internal range to external range draw. And if this sounds foreign to you, go watch my previous market maker video. And that's going to complete the daily draw, moving from our daily fair value gap here, our SIBI, right, putting in a 3-bar topping pattern, all the way back down to this shallow kind of double bottom here, and this shallow raid of this inefficiency, or shallow rebalance. So the sell model is still in full swing, and is exactly what we expected. However, moving into today, I expected kind of to see some pattern like this, simply due to the nature of the price run we have had over the past 2 days. If you look, we have been putting in lower lows and higher lows. Now, when we put in, a full day of lower lows and higher lows, and especially yesterday when we failed to displace with meaningful displacement. So displacement can be measured in various forms. I'm going to now use a definition that's predominantly weighted in a fair value gap creation. So as you can see on the hourly chart, we don't have a fair value gap created, a single one created yesterday. In fact, we're putting in what some people might refer to as a channel, right? We're chopping downwards, and we're creating an efficient move, right? Downwards and upwards, incredibly choppy price action as we move down. Now, usually when we see this, the liquidity run to the sell side becomes extremely high resistance. High resistance liquidity run simply looks like this, right? Higher lows, or lower highs and lower lows. And every time we take sell side, we meaningfully push back into the range, as you can see. So we take sell side, we move back into the range. We take sell side, we move back into the range. We take sell side, we move back into the range, etc., etc. Now, what we're doing actually is we're putting in, right, this LR signature, this low resistance liquidity, to the buy side. These now turn into failure swings up here. So if you look at your chart, you can see on any time frame really that now we're putting in a level of failure swings. This is going to be low resistance liquidity that can be used by the market to fuel the next leg down. So to recap, on the day, right, I'm going to turn my fan up a bit because I'm using a lot here. On the day, I was bearish, and I'm still bearish on my highest time frame, which is my daily chart. However, I expected a meaningful level of reversal or run on stops today, potentially going as high as a level that was framed by a market maker model. So now let's jump into kind of how I used this idea of my trading model and market maker models to really dissect where I thought price was going to go. Okay. First of all, any questions about consolidation Thursday reversal profile, why we're expecting some sort of manipulation higher today? Does everyone okay with that kind of thesis? The thesis that is, although we're in a sell program, I wanted to see some measured run to the buy side to both, one, stop out, a lot of weak shorts, but two, capture some of this low resistance liquidity that we have been building for the past kind of, 6-7 trading hours the previous day. Lots of low resistance failure swings. Everyone understand that? Let me go to the chat. Yep, makes sense. Cool. Everyone else makes sense? Makes sense? So you recommend us to learn the weekly profiles. I think weekly profiles are advantageous, right, when you compare that with narrative. And then you can plug that into a market maker model, and then you start to get a lot of different pieces that work together. That's how you can kind of start to call tops and call bottoms. So while I wouldn't say weekly profiles are always necessary, I would say, for example, expecting in a classic sell week a Monday manipulation is something very prudent that you study, right? And I teach all my students who I work with about some common weekly profiles like Monday manipulation in a classic sell week. Because even if we are bearish on the week, right, we have to be able to put in a high of the week, because every weekly candle is going to look like a opening, right? So say, for example, we have a weekly candle. And this is going to be a down close candle on the week. We're expecting to see this down close candle. So this is the daily chart. Now imagine this is the weekly candle. We are going to be having a opening price, which is going to be our true week open. Right? And now we're going to be putting in a high, which is going to be some sort of wick. And I'll make this black. Then we will be putting in a low on the week. Right? Followed by a close. And let's say the candle body just closes here. Now, if we understand power of three, right? We understand that if you want to be a short seller in this week, just like if you want to be a short seller on any day, right? Look at a daily. It's very, very rare that you'll see a candle without an opening, high, low, close. Meaning that often, if price, even if it's incredibly bearish, will still manipulate above the opening price, which is the true day midnight open. You can see it, right? This is the opening price. Price will often manipulate above the true day open in order to get a favorable discount or premium seller buy, depending on what the day is, bearish or bullish. So in a weekly profile, it's the exact same thing. You want to be a seller on a bearish week in this region of price, right? Above the true week open, anticipating a wick to be put in as a high before a distribution throughout the week lower, followed by a close. If you guys follow me, you know I'm a big fan of the TGIF setup, which is the 20 to 30% weekly retracement. Now, that TGIF setup looks, where is it? Do I have an example here? I can pull up my Twitter later. So I don't want to pull it up now, but it essentially looks like a retracement on the week that closes us back into the range. And if you look at my Twitter after this lesson, you'll see I play TGIF almost every week, right? And there's meaningful levels of weekly retracement that's capturing this entire power of three movement I'm telling you about, right? You're playing on Fridays this move back into the range, essentially putting in the close, right? Opening, high, low, close. That's why weekly profiles are so interesting to study, because it's expected that every weekly candle will interact like this and put in these two wicks, just like every daily candle will do the same thing. So as you can see today, we have an open, a high, a low, and a close. And in this case, the low and the close are very close to each other, signaling extremely bearish price delivery. However, this manipulation above the true day open, the midnight opening price, is where you'd want to be a seller, right? And that's how you can frame intraday profiles, which I also teach. So there's weekly profiles using power of three on a weekly wick, for example, and then there's daily power of three. The concept of buying above the midnight opening price if you're, or selling above the midnight opening price if you're bearish, and buying below if you're bullish. That's what I would say is a good justification for understanding profiles, weekly profiles, and intraday profiles. So anyone have a question about that? The TGIF starts after price takes the week's draw on liquidity? Absolutely. Yep. So we anticipate TGIF to occur once the weekly draw has been met, forming, right, this wick, this weekly wick. So if you were to ask me what I think tomorrow is going to deliver, if we continue bearish price delivery, I expect us to take out this weekly and daily drawn liquidity, which is external range, and then close back within the TGIF range. So let's say, for example, we come down to this area right here as a prediction, our weekly retracement could look something like this. And we'll have order pairing below this low, and we'll close back into the range. So we'll look something like this in terms of delivery. Now, this is a lot of price movement that could happen tomorrow, so we don't know. We don't know if we're even going to get this daily draw tomorrow. However, TGIF can be used tomorrow, right, on Friday, once we establish what we believe to be the low of the day put in on Friday, whether it's going to be a reaction off of these wicks or it's going to be a reaction off of the CE of this wick, for example, is something I will be considering, right, down here. Whatever that is, we can anticipate the weekly candle will close a meaningful level back into the range. Go to my Twitter after this lesson. I've played TGIF the past 3 weeks. I'm 3-0 in the past 3 weeks on TGIF, and the accuracy of that range has been very, very precise. Like, there's been very high sensitivity towards the TGIF 20 to 30% range. I don't expect anything different tomorrow. I think that's what CE of the wick. Yep. PO3 is part of MMXM. Absolutely. PO3 is one of the most fundamental ICT concepts, which is just accumulation, manipulation, distribution on all time frames. So now that we kind of have some basics about why I expected to see some level of manipulation today higher, let's talk about what we see on the charts. Okay. So I traded both sessions today. I traded London session and I traded New York session. Now, in the London session, as you guys know, I teach the hourly to daily to 5-minute market maker model. So let's take a look at what that looks like on NQ. Moving into the London session, right, which is at 2 a.m., I saw the following. You see this progression right here. I expected us to make a meaningful run lower, right, in London before New York making that prediction I had, which was going to be the run on buy stops. And again, this was to do with the weekly profile. So if you look at my channel, I said I'm expecting, right, some level of bullish prices in London because I want to put in the low of the day in London. That was my anticipation. So given that weekly profile, we can frame, or that daily profile, we can frame trade ideas just around that. So in London, as you can see, we open up and we put in this double bottom here. Now, this double bottom here was something I was very interested in observing how price reacts to. And if you look at my channel in Naps Discord, and if you kind of follow some of my alerts, you'll see that I played both legs of this manipulation and distribution. So I was expecting a run into this level, 1949.5. As you can see on the hourly chart, that is the original consolidation in this hourly market maker model. And I'm not going to go through explaining market maker models today. That's a different lesson. This is just a price review. Okay? So it also lines up with our fourth deviation of this, projected range. So it's a lot of confluence for this area to be a reversal area. Again, if you don't understand that, watch the previous lecture. It'll make more sense. So what I did was I waited for the session to open, and then I waited to see if there was a purge of buy stops or sell stops. And in this case, you can see we put in a double bottom here and SMT with ES. So in this case, you could have played this long, and what I targeted was the 2 to 2.5 region. Very, very standard level for reversal, right? That's what a good target tends to be. Now, the real trade that you could take, right, if this is the manipulation, is the distribution, right? Again, this is power of 3. Accumulation in here. Deviation above the range. Distribution below the range, right? This is anticipated given what we want to see as higher prices on the day. So you can trade both sides if you want using a market maker model, right? We put in an SMT with ES, so we sweep out a form of hourly liquidity right here, which would be considered a purge. Then we break structure to the upside. Right here would be considered your market structure shift. Then, I have it marked out here as on the downside. Here is your fair value gap, which is your low risk entry. You long this fair value gap, which is called a low risk entry. And you target, low hanging fruit. Low hanging fruit in this case, as you can see on your hourly chart, is going to be this swing high, right? Or the 2 to 2.5, because you're expecting manipulation before distribution down. So I traded that. It's on my Twitter, all the executions and everything. You can go look at that. Then I got the exact same, right, setup that I wanted on the hourly, using a market maker model on the hourly, towards the sell side. We got a purge of hourly liquidity like I have right here, followed by a market structure shift to the downside. We break below this low, right? And then this right here is my entry. This is a breaker block, right? As we close through, annotate it for you guys. As we close through this low, we activate the breaker block. You can take a trade as you trade back into it right here, right? As you notice, the fair value gap here doesn't ever get retested. So you wouldn't have gotten an entry at the fair value gap. Price is in a hurry to move because, right, we've used these stop losses above this high as order pairing to move lower. And if that's confusing, that concept, order pairing, it doesn't make any sense to you, watch my last lecture. It'll make more sense. So this AMD gave me an entry here, and I targeted here. Now, what's another confluence for this low being, the low of the day or the low of the session? Again, we can take a standard deviation projection, and we'll look at the 2 to 2.5, right? 2 to 2.5, 2 to 2.5. These reversal areas are very common. For reversal. So as you can see, I'll pull up my Twitter and just show you kind of what those trades look like. Okay. So if you're expecting bearish delivery, you should anticipate a run higher into premium, targeting buy stops and premium PD arrays. If you understand how inducement is used, you can trade both the manipulation and the distribution. So as I said, I traded the manipulation, understanding that this was going to be a reversal later, right? And then I traded the distribution towards the target. Now, as you can see, here's what the chart looks like I just showed you. There's the low risk entry on either side, and here's the reversal at this high probability region on both sides. So these are the types of trades I like to take in London if I have a very clear bias. Like today, my bias for London was going to be manipulation and distribution. So I wanted to play both sides of it. As you can see, there was a market maker model, if you look at my last lecture, that supported both longs and shorts, and all you had to do was decide which one you wanted to play. I play both. I would recommend to most people just to play the distribution in line with your higher time frame draw, which is going to be to the sell side, right? Another thing you can notice is that sell side delivery here is almost to be expected because we're putting in this set of equal bottoms. So this double bottom here now turns into engineered liquidity. So engineering liquidity. Now when you notice this on a chart, and you can kind of pair that with a narrative of accumulation, manipulation, distribution, this becomes a very strong magnet now for price to return to. As you can see on your hourly chart, this became, right, like a double bottom right here. Right in here, which was a very, very strong signal for the reversal eventually to this area. And this area, again, right, is the market maker model terminus, which we've learned about. This is the original consolidation. We're expecting a run on that area. Okay, so now that we've traded that, does anyone have any questions about kind of how London's price action worked? It was kind of a beast. It moved aggressively in both directions, but there was definitely some clear narrative to support the price action in London. Questions about that? Also, I apologize if I sound a bit tired. Didn't get a lot of sleep last night, and I have a young puppy who barks a shit ton at night when I do sleep. The distribution was also the sell side of the curve for the following market maker. Yes, absolutely, and we'll get into that. Good eye. So you use Asia as narrative in a way. Yes, absolutely. I use this double bottom here coming into. So this is like late Asia, right, or pre-London. Yeah, definitely. This double bottom gave me a very high confluence draw for the sell side delivery, right? Again, I saw Asia chopping down, and I'm creating low resistance liquidity. In the same way, you're going to notice a very, very similar concept to what we saw today in New York. We have low resistance liquidity, and then we have power of three: accumulation, manipulation, distribution. So when we see a deviation outside the range, right, on a bearish day, that should be expected. So if all of you guys have Twitter, I'll go back and I'll show you something else. This is a really, really good kind of concept to familiarize yourself with. Right? The market operates on manipulation. If you're bullish, you want to see an initial run lower. If you're bearish, you want to see an initial run higher on all time frames. Manipulation and inducement of the opposing party liquidity is what actually drives the market. So if you're bearish and you don't see something like this, it's a lower probability trade. Likewise, if you're bullish and you don't see something like this, then it's a lower probability trade. You want to see, right, a meaningful purge or return to discount or premium opposing your drawn liquidity. That's why my two rules are always going to be waiting for either an hourly purge, right, or a return to a premium or discount PD array. In my model, I'm putting in these rules, these caveats that make sure I'm waiting for, manipulation to occur before I enter a trade. And as you can see on both sides of this trade, whether you wanted to play it long or you wanted to play it short, you had to wait for meaningful manipulation. So that's it's definitely how I use Asia. I used Asia as the area that I was looking to manipulate from. Above or below, deviate above or below the range. So now that I'm coming in to New York session, what is my expectation on the day? You already know. I am now thinking about higher prices, at least on an intraday time frame. Recognize that even if we're in a sell week, like we are, you can have up close candles, right? You can have bullish price action as a function of retracement in a bearish week. So how did I frame a narrative that supported a bullish retracement in a selling week? Well, as you can see, there's time frame continuity with market maker models. So this low down here that I'm looking at on the hourly, right, is not a daily swing low. Is this candle a swing low, guys? No. On the daily chart, if this was the 1 minute chart, would you consider this a swing low? No. This down here is a swing low right here. Right? This is a swing low. This is a swing low. But there has to be a 3-bar pattern to constitute a swing low. This is just simply previous day low on the daily chart. So I cannot frame a bullish retracement from the daily chart using a market maker model. However, on the 4-hour, you can clearly see that this level that I'm looking for some level of reversal intraday from is a clear swing low on the 4-hour chart. Okay, keep that in mind. And now remember our time frames for market maker models. If we are looking at a 4-hour PD array or POI, right, then we're going to look for an M15 structure and an M1 market maker model, right? This is the rule. If this is unclear to you, go watch my previous lecture. I talk all about the time frames you can use for different continuities. So I'm now going to keep this in mind, right, as I move into the New York session, expecting a meaningful run on buy stops, okay? Intraday. In the sell program, we've now reached a 4-hour key level, right? So some people call PD, they say the PD array or the POI is called a key level. which would frame a smart money reversal, meaning it would frame a bullish set of prices from this low, right? We're in a 4-hour fair value gap and we have a 4-hour swing low. I am going to be using this, right, as my thesis for long positions intraday in the higher time frame sell-off, which we all want to see down to this level, which we've been calling, I think, for over 2 weeks now, right? We've wanted to see this move up, then this move down. It's perfect. Right to script. Okay, so now that I had this 4-hour area get hit, I now go to my 15-minute chart. So once my 4-hour area gets hit, we go down to the 15-minute chart. And the 15-minute chart is what I'll show you on this screen, actually. So on the 15-minute chart, after tagging this 4-hour sell side inside a 4-hour PD array fair value gap, we get a 15-minute break of structure. This activates a 15-minute market maker buy model, right? Remember, 4-hour key level, 15-minute structure, and we are going to trade a 1-minute fractal. That's time frame continuity, folks. So as you can see on this chart here, I had a clear original consolidation of a 15-minute market maker model up here. So I thought price could draw up to here potentially. Is this going to be my only take profit? Absolutely not. Because the reason why I have a 78 or 80% strike rate is because I go down to the lower time frame and I trade the fractal market maker model on the lowest time frame. What does that mean? That means that every single retracement on my intermediate time frame is a complete market maker model on my lower time frame. I'm going to say it again. Every retracement on my intermediate time frame, either to a PD array of interest or to a purge level, constitutes a complete market maker model on my lowest time frame. Don't believe me? Let's look at some examples. Okay, let's look at the one I teach you guys, which is going to be the hourly, the 5, or the daily, the hourly, and the 5. So let's look at this 5-minute chart here. And on the right-hand side, I'm going to have an hourly. Sorry, we're getting a bit aside. I just want to show you what I mean by when I say a retracement is a full market maker model. Once we hit the buy-side liquidity, last week and break structure to the downside, this market structure shift signals a sell program activation in market maker models in terms of what the market is going to do. And you can see, right, last week, once we broke structure here, we had clear targets, right? This is the original consolidation. This is the first phase of accumulation right here. This is the second phase of accumulation in here. So we expect to see, price come down to here, retest this area, consolidate, retest this area, consolidate, and then retest this low eventually. I mean, if you zoom out right here on the hourly, this is a beautiful market maker sell model. Okay. I'm not targeting with my trades on a daily basis this low or even this slow on the hourly. The return to this inefficiency. So what's the rules I teach you guys, right? Let me get rid of this. Say, for example, you're trading my model in New York on Friday, October the 13th. We get a purge right here. Okay? Once we get that purge inside this fair value gap, right, we go down to the 5-minute chart. What I'm going to try and convince you is that this return to this fair value gap and this purge will be a 5-minute market maker model all by itself. So yes, the target is lower. It's this low, for example. Yes, obviously, in the 1-hour market maker model, you want to target this low. Cool. Let's keep that on the chart for a runner. What I will convince you of is that there is an entire market maker model in just this one leg of price. Let's zoom in. Let me go down to the 5 here. So let's sync this in the layout so you can see it. Would you look at that? This is the market maker model you're trading. This is the sell side of the curve. This is the buy side of the curve. This is the smart money reversal. This is the original consolidation. You can zoom into price, right? Let me unsync this so this bubble goes away. It's annoying me. This is what I'm trading. So then I'm trading this market structure shift right here, right? Or I can trade this market structure shift right here. Both are valid. Then I can take an entry in this order block like I teach you guys, or this mitigation block if you want to call it. Whatever you want, whatever entry model you like, right? You can take an entry model based on whatever fits your risk, whatever fits your criteria. If you don't get that, here's another entry you can use, which is called a redistributed, rebalanced PD array. If you don't know what that is, watch the last lecture, I teach it. So let's say you take this redistributed, rebalanced PD array. Now your first target, guys, is going to be this low. This is the market maker model you're trading. This retracement on the intermediate time frame is a complete market maker model on the lower time frame. Where are you going to hold your runners to, right? Well, you can hold your runners. So your first target is going to be right here, right? There's the 5-minute market maker model. Buy side of the curve, sell side of the curve, right? This is a very aggressive sell side delivery, but you can hold your runners to here. In fact, look at the hourly. You can hold your runners all the way into maybe this fair value gap, so you can maybe hold it even deeper. You don't need to though, because you're framing a 5-minute lower time frame market maker model. Here is the actual trade you would take. Now, after this lesson, go and back test how every single purge in this sell-off that we had all week, right? Look at this day. New York comes in right here, for example, like this, and purges this level. This in here, this move up right here, same thing, is a complete 5-minute market maker model. Let me sync this again and prove it to you. Would you look at that? Original consolidation, buy side of the curve, sell side of the curve. So what's your target? Your low-hanging fruit target, guys, is right here. It's the 5-minute market maker model contained within the retracement in the 1-hour market maker sell model. So now we have the daily favoring a sell model. We have the hourly favoring a sell model. And you're just trading this small fractal of price. This is why my strike rate is 80%, is because you have time frame continuity. You don't need to hold all the way for this low, which eventually you get the next day. You get to trade a complete market maker model right in here, right in this retracement forms your market maker model. All right. And that concept was used again, right, in London. I told you. This purge right here is a complete market maker model to the sell side, and then a complete market maker model to the buy side. It looks uglier. It doesn't look as clean maybe as, this, but it's still a complete market maker model. So now let's use that same analysis I'm giving you to discuss how I went long today. Any questions, first of all? Yep, it's going to be recorded, Leo. Yep, I'll send it to you. Any questions about that idea of fractal price delivery, right? So that means that a retracement on your intermediate time frame is a complete market maker model on your lower time frame. Okay. So now, like I said, I'm going to use the 4-hour thesis. Once I came into this area here on my 4-hour right here, and I broke structure on my 15-minute chart, I am now framing a market maker buy model, right? So let's look at how today me and my students called both the 1-hour sell model into the 1-minute buy model. Look at this. Okay, so I'm going to show you both. Say, for example, you're only trading the hourly 5. Okay, I'm going to write it out here because this is confusing. This was why price action was so nuanced today, in my opinion. Say you're trading this model. You are trading today. Your daily is your higher time frame. Your hourly is your intermediate time frame. And your M5 is your lower time frame. This is the model I teach you guys all for free. That was the model everyone learned from me. XYJ's favorite bread and butter model. Let's take a look at how this played out, right? I'm going to get rid of all these annotations, by the way, and we're going to do it together. Okay, we're going to do it together to show you how I came up with all of these annotations. So what I will keep is just what we're seeing on the 15-minute chart, which is this. Actually, you know what? Let's just do the hourly. Screw it. Screw it, screw it, screw it. You are trading the model I've taught you, okay? Which is going to be daily higher time frame, hourly intermediate time frame, minute 5 lower time frame. Let's frame the trade. Moving into New York session. This looks like terrible price action, right? Let's see if it really is. On the hourly, do you guys see where we get our purge? We get our hourly run on buy stops, right? Right above this high at around 8 a.m. Exactly, the 8 a.m. hourly candle, right, is our run on buy stops. Okay, fantastic. Now what are we gonna do once we have the hourly condition met? If this is foreign to you, right, go watch the previous lecture. The condition is a purge opposing the draw, right? We're still targeting lower prices on the hourly. We want to see all the way down here and here. So the hourly model supports a lower price schema. Okay, so now we get the purge. We're also returning into this hourly order block. Here is 2 conditions that I teach you guys. 1, return to a premium PD array, right? This order block. Awesome. On the hourly, this is H1. 2, an hourly stop hunt. Both conditions are met. Now we can move down to the 5-minute chart, okay? On the 5-minute chart, let me get rid of this. Let me get rid of this. I'll keep this here just for context later, okay? This is our hourly order block. Let's make this red so it's clear. Once we get this purge and we come back in this hourly order block, we wait for a 5-minute break of structure because we're trading this model. As you can see, we get a 5-minute break of structure right in here. Okay? This is our M5 market structure shift to the downside. Just following the rules I've taught you guys, now you enter on the first premium PD array. Do you guys see the sell model in here? I see it. I see it clear as day, right? What is it? I see an original consolidation right down here with failure swings that look like this, right? And then I see a distribution into the buy side. Now I'm seeing a breakdown, another failure swing, right? So more low resistance liquidity, followed by a move back up into this premium 5-minute order block. Awesome. So this is our M5 OB minus in premium. Fantastic. This is a full market maker model. From this area down to these lows, that is the market maker model I'm trading. From the hourly down to the 5. The retracement higher on the hourly, even in this choppy, shitty condition, is a full market maker model on the 5-minute. If you want to know which PD array to choose, simply take a dealing range. You want to enter on a PD array that's above 0.5. This fair value gap isn't above 0.5, right? So this fair value gap isn't the premium PD array. That's why we trade through it. The premium PD array is this order block. Say you enter here, you short the market somewhere up here, stop loss high of the day, right? And you're targeting low-hanging fruit. There you go. There's your 60 points. This is a valid and complete market maker sell model using these 3 time frames: the daily, the hourly, and the 5-minute. Now, the more experienced eye is also going to notice, right, that on the hourly, so that's the trade. There you go. Nice. You guys got 70 points. Fantastic mechanical trade. No emotions involved. Just execute the model. On the hourly, you'll notice we actually have a fair value gap in here. I'm going to keep this on my chart, guys. Just bear with me. This fair value gap is going to be very interesting to me. Whoops, that's not what I wanted to do. I want to get rid of this middle line. Okay. So as you can see, the 5-minute market maker model that we're playing delivers us to this H1 inefficiency. Okay. So that's the goal, you can say, of this 5-minute market maker model, because it's a retracement back in to a premium array that then redelivers a discount array. Exactly what I taught you guys about ERL to IRL. Look at the hourly, right? We're going from a swing high back into a fair value gap. That is the perfect bread and butter trade. This is exactly what you want to see. You want to see this, and it delivers. Now let's talk about the other trade. So say you're not this trader, but now you're instead a different time frame trader. You are instead trading the 4-hour as your higher time frame, the M15 as your intermediate time frame, and the M1 as your lower time frame. What I'm going to convince you today is that the 5-minute market maker sell model was simply the retracement in the 1-minute market maker buy model. I'm going to say it again. We had 2 market maker models on 2 different time frames that were diametrically opposed, meaning the 4-hour wanted to be a long, right, market maker model based on this reversal down here, and the daily higher time frame wanted to be a short. So we got the M5 market maker sell model based on everything I just showed you, right? Hourly order block, hourly purge, 5-minute order block, right? Return after market shift. I'm going to delete these guys. Just remember, they were on there. They were there for a minute ago, and they were a valid trade. What I'm going to convince you is that the 4-hour was equally as valid, and this return into this H1, buy side and balance outside inefficiency, this value gap, activates this other time frame, this separate time frame market maker buy model. Okay, so look at the 15-minute now. So now I'm done with this guy, right? This guy's already done. This guy, how many points did he make? This guy's TP1 was 67 points. Fantastic. This guy made 67 points. He's really happy with himself, and he's done for the day. Hopefully, that's a really good trade for the morning. Now let's take a look at this guy. This guy is what I was today, which is using this level and then seeing this 15-minute market structure shift to frame a buy side run into stops. Okay? Don't believe a student called long day. Check out my Twitter post. Okay. Yes, AJ was one of my first students, and I've worked with him on these models a lot, so he did actually see this long. And I played this long as well. I didn't play the shorts, although I called out live with my students both sides of the market using exactly what I'm telling you right now, which was a 5-minute market maker sell model into a 1-minute market maker buy model, and I knew that both sides were equally valid and both sides could be played. So when you're seeing chop and shitty price action, I'm seeing specific algorithmic price delivery. So above this high on the 15-minute is where we get buy program activation above this 4-hour level, right? Same thing I showed you on the 1-hour up here. Remember? Once we tap the daily level back here, and we broke structure on the 1-hour, we're now in a sell program targeting a market maker sell model. Cool. Same logic, guys. On the 4-hour, once we tap in to this level and break structure on the 15-minute, we now have a valid, right, 15-minute market maker buy model. I'm going to get rid of this BISI. Just remember what I said earlier. The return to this hourly gap was the objective of this guy. This guy got that. Now let's frame this guy. The first fair value gap that's created after we break structure in here is this. Who here, from a show of, this is called a low risk entry. If you guys have been to my lectures, you know exactly what that means. Who here has watched my lecture on inducement? Give me a yes or no in the chat. Well, I check what type Haven't. Okay. Smokey has. Manip has. AJ has. Not yet. Cool. It's on my YouTube. So my YouTube's just XYJ Trades. I have it on my Twitter as well if you need to find it. Please watch that lecture. Any order for the other videos. Yeah, I would start with the MMXM. So MMXM number 1. Then I would watch inducement and protraction. Yeah, no worries, Frieden. Take it easy, brother. That's number 2. And then number 3, I would watch my TGIF video on YouTube. That's number 3. So that's the order at which I would watch my YouTube videos. Yep, no worries, Niku. Okay, so as you can see, this is our low risk entry. For those who came to my inducement lecture, what the hell does this look like? I linked it earlier because I knew I'd talk about it today. So I put this as a pin. I'm a copy this image, and I'm gonna put it in the chat for you guys so we can all look at it. Okay. Study the schematic. Right? This schematic right here. Okay? Compare this piece of price action that you see in this general schematic with what you see here. What similarities do you see? Let's rewind price a bit. What do you see in similarities between what you're seeing here and what I show you here? Do you see the inducement model forming? Failure swing up here. Look, let's play another 15-minute candle. Failure swings up here. Low resistance liquidity, right? Failure swings up here. Inducement near the higher time frame PD array. In discount. Inducement is this. A failure to come back in to this PD array, creating low resistance liquidity right below it. And failure swings above it, right? What did I say inducement was, guys? A two-way fuck, right? Failure swings on either side. We're framing the candidate for a market maker buy model on the 1 minute is getting stronger and stronger when we see this, right? Exactly what I taught you guys was inducement. Okay. Now watch. We trade into this 15-minute gap. Once we trade into here, even though we are in a 1 hour sell model, which remember, that guy already made 67 points on this move down, because this move down, right, into this hourly gap was the 5-minute market maker model. We're now entering a new type of trader, which is going to be this time frame trader with his market maker model. This buy model is just as valid, guys, as this sell model was. And I actually didn't trade the sell model, I traded the buy model. And I told my students you could have played either one. If you have narrative and you understand the draw on liquidity, you'll make money on trading both. It's not random. It's not choppy. It was choppy, but it's not random. Price delivered perfectly. So once we come into this 50-minute value gap, now we can frame a 1 minute market maker buy model, right? Just like we did with the 5-minute from the hourly, right? We go from the intermediate time frame down to the lower time frame. This in here, guys, this retracement, do I have to say it? What do you guys, what is this retracement going to be on the 1 minute based on what I've talked to you in this lecture tonight? Someone put it in the chat. Someone come off mute, say it. Market maker sell model or market maker buy model, right? We're playing longs. But yes, you're right. This is a market maker sell model down. Yep. I want to see more people say it. What is this retracement on the 15-minute going to offer on the 1 minute? A market maker model. Everyone say it. It's going to, yes, sell, yes, market maker buy model, market maker X model. Yes, this retracement, even though I said price could come all the way up to here, right? I said price could come all the way up to 1523, right? I liked framing this as a potential area. So I liked looking at this and being like, okay, look at my projections. I want to see maybe up here. I'm not taking my whole position off here, guys. That's stupid Because this is the market maker model we're trading. So although there is a higher time frame for our draw, this original consolidation on the 15, this in here is how you get an 80% or 78% strike rate with an average 3R. This is how you get payouts. This is how you get funded. This is how you make real money, is by using time frame continuity and understanding what it means. This retracement on the 15-minute is a 1-minute market maker model. Just like this purge on the hourly was a 5-minute market maker model to the downside. Let's zoom in. Do we see the market maker model? Wait, where'd my little thing go? Why is this not visible? Whatever. Do we see the market maker model in here, guys? Do you see the failure swing right here? Original consolidation, right? Distribution, come back in to this order block, premium order block, sell off again, right? Here was the original consolidation on the buy side. So look, buy side of the curve, sell side of the curve, reframing a buy side of the curve. The market moves in these buy and sell side curves. I already know that if you know anything about how I trade, right? In the same way that we had a buy side of the curve and a sell side of the curve here, we're having the exact same thing because these are failure swings down here. Once we take these out, right, we're now framing the buy side of the curve. And on the 15-minute, that simply looks like a retracement. Okay, 1 minute. What do we wait for on the 1 minute, guys? Do we blindly enter the 15-minute gap, or what do we wait for on the 1 minute? Someone write it out for me in chat. What am I waiting for on the 1 minute? MSS, yep. And return to discount PD array, right? MSS, return discount PD array. Let's make it mechanical. Here is my market structure shift. Here is my first fair value gap. This is my low risk entry for a 1 minute market maker model with draw here, not up here. That's the 15-minute. We're playing the 1 and we're going to leave a runner for here. It's how you get a high strike rate. Okay. Price starts to accumulate and tags us in. Now, once I'm here, right, if you guys know how I trade with the invalidation of my intermediate time frame. I'm going to say it again. I trade with the invalidation of my intermediate time frame. Why? Because my lower time frame is a 1 minute chart, and a 1 minute chart is not true narrative, guys. The narrative here is a 15-minute market maker model, right? This is the high we're targeting. Failure swings. LR signature. If none of this makes sense, watch my market maker model video. This is the draw on liquidity now. Maybe here, but definitely here. I will wait for invalidation on the time frame of my draw. The 1 minute is the model I'm framing, and it's my entry criteria, just like the 5 minute is for my hourly. But because I know that the draw is higher and we need to get this, I will wait for invalidation on that time frame. That's how I play it. You don't have to play it that way. You can get stopped out and re-enter, for example. So me, this is what happened. And this is all in my Discord. This is all in, like, I on my Twitter, I posted every single pyramid I took, every single time I held, all the analysis to why I didn't cut this trade. So someone tell me, I just fast forwarded a lot of price action, why I didn't cut this trade. Now this is going to be an order block. Okay. Look at the 1 minute. The 1 minute comes through our low risk entry and comes down almost how many points of drawdown? 50 points of drawdown. Now you can cut this trade. I'm absolutely okay with you cutting this trade. I didn't. And I was looking, right? at the 15-minute for my invalidation, because that is what I'm framing this high as the draw for. It's a 15-minute buy program activation, right? This low risk entry. So why didn't I cut this trade, guys? In fact, tell me why I didn't not only cut this trade, but I also added another set of average down contracts down here on this 1 minute breaker block. I added more contracts when we traded into here. Someone tell me why in chat right now why I did not cut looking at the 50-minute. Bodies. If 15-minute is narrative, what's the H4 then? H4 is your higher time frame PD array. This frames the HTF time frame frames a reversal from a key level. Just like we had a daily reversal at this level, validated by a hourly market structure shift at this level, which you can see, right? Market structure shift right here from a daily level. Down here, we had a 4-hour level validated as a smart money reversal by a 15-minute market structure shift. Time frame continuity. So, based on what I just said, right? Why didn't I stop out? Intermediate time frame not invalidated. Bodies. Does that make sense to everyone? Give me a yes or no. Does this make sense why I didn't stop out and why I actually added more contracts at valid PD arrays on my lower time frame? I pyramided in at this breaker. I also added 2 more contracts at this fair value gap in here. So I went from 8 contracts to 14 contracts of micros because it was a valid setup. But I want you to understand now that you have to understand this. Like, does that make sense to you? Everyone say yes or no. Liquidity sweep as well? Sure, exactly. Yeah, this is the bodies are telling me the story. My order block in my dealing range of premium and discount. Look at my premium discount dealing range, guys. What level is being respected? Here, let me do a fib so it's easier for you guys to see. Tell me what level is being respected in my 15-minute buy program thesis. Optimal trade entry. This order block in optimal trade entry. Right? Does everyone see why I held this position? Yes or no? Now, yes. I see lots of people in yep. Everyone give me a yes. I need you to say yes so we can move on because it's an important concept. Yes. I'm see people type. Cool. Okay. So this is why I held. Because the invalidation of this thesis for the long is not the 1 minute fair value gap. That's the entry model, guys. That's just the entry model I used. And I could have used an entry model off this order block, which might have been better. The thesis is a 15-minute key level reversal framing, right, a 1 minute market maker buy model. All I'm seeing right here now on the 1 minute is high resistance liquidity being generated to the sell side, right? Lower lows, and we're failing to break down. On the 1 minute, you can see this is lower lows and failure swings. Look at this, guys. Come on. This is exactly what I teach you want to see. LR, low resistance liquidity. Okay. So high resistance liquidity to the sell side, low resistance to the buy side. We have a key level that's being framed, right? That 4-hour low. We have a 15-minute narrative that's being supported. Let's get rid of this for value gap and just look at this order block. This order block is the only PD array which is in a deep discount of this dealing range, right? This fair value gap is in 50 to 60.8. This is in the 70.5 region. Deep discount. Okay. Watch price deliver on the 1 minute. What do you guys see in just this piece of price action right here? What is this? Market maker buy model. Yes. Framing this overall higher time frame 15-minute market maker buy model. So you have this as a first partial, which I did. Look at the channel again. I'm not bullshitting. I took like a third of my position off here, and I said quote unquote. All right, let's put it in what I said. Took partials, risk free, holding most for 15,109. Right? Go find that quote for me, because the narrative now supports this high. I still took most of my position off, which I averaged down here at 40-ish points. Actually, my average was more like this. So 57 points. And I set up my stop loss to break even, and I said, we're going here. High, gun to my head, we're going here. I'm not going to force it, because this is the market maker model. I had an early entry here, right? It wasn't invalidated. It just simply traded back into a higher premium or higher discount. Then it created a whole market maker model. So of course you take partials here. Of course you take partials. If you don't, you're just stupid. This is the trade, right? This 15-minute retracement looks like nothing here. It looks like just nothing on this chart. But on the 1 minute, it's a whole market maker buy model. Let's watch price deliver. Look, my stop loss is break even, right? I always manually stop out for this reason, right? As my students know this, I never have a fixed stop loss, and I don't recommend that, but this is why I don't. This in here, right? When people say, oh, like random news candle. No, it's not a random news candle at all. This news candle is narrative. We're repricing, right? This fair value gap right in here. Where is it? If you notice, this is the low risk entry for this market maker model. Once we break structure above this high, this is the first fair value gap, right? That's the first fair value gap created after we break structure here. Okay, we're repricing it, redelivering it, stopping out everyone who's a week long, and then price goes to terminus. Okay, this is the market maker model we're trading. Whoops. We have our sell side of the curve, and we have our buy side of the curve. That is the model we're trading right in here. Sell side of the curve, buy side of the curve. The 15-minute retrace to this LRE, to this low risk entry, this order block, frames a 1 minute market maker model. So now whether or not you were the guy, right, who traded the 4 hour, 1 hour, or you traded the 4 hour 15-1, or the daily H1M5, you made here, you made probably 80 points. TP1 was 57 points. There you go. Diametrically opposed biases. Short biased, long biased, both are permissible. Both gave a perfect market maker model in terms of execution. I traded the 4 hour one today, and I'm sure others traded, some of my students traded the shorts, and everyone wins. This is why I don't give signals. This is why I teach how to trade, because this is how the market books, right? And then once the market reprices this level in here, again, that frames a what time frame sell model. Look at the hourly, guys. Look at the purge right here. Right? This is a swing high. Okay. Now we have a continuation purge in the higher time frame daily sell model. Now we have the purge. Now let's go to the 5 minute, and everything I just said holds again for the market maker sell model. This is the premium PD array. This is the order block on the 5 minute. This is the break of structure right here below this low or this low or this low, whatever you want to call it. Let's call it this low. We return back into the premium PD array, and then we sell off. Right? Then we sell off Because the higher time frame sell model has been matched with the lower time frame buy model. There's been order pairing above these highs. So this purge on the 1 hour was a 1 minute or 15-minute market maker buy model. This move in to the higher time frame sell model was a lower time frame buy model. It's not random. These moves into the purge, into the premium PD arrays that frame your reversals, right? On the hourly M5 that is going to be a lower time frame market maker buy model. And that's what I showed you can trade today. That lower time frame buy model was in. That's what I traded right into here. Then you could trade the 5-minute reversal if you wanted. I was not trading at this point in time anymore. Because in my head, I saw both biases, right? I saw we could still reach up for 15,223, and I had already taken, a couple $1,000s of gains, and I was very happy. But I was more so happy with the delivery more than anything, right? Seeing that we had a lower time frame market maker buy model in a higher time frame market maker sell model, and both sides of the coin, no matter how you interpret this chart, if you follow the rules I teach you about time frame continuity, you got a trade that was valid. Okay, so that was today's price action. Obviously then, we had a purge, a return to an order block, sell off, right? We're continuing our sell off. The higher time frame draw remains the higher time frame draw, right? I'm looking at these lows because the hourly still supports the market maker sell model. Look at the daily chart, right? Now, if you're wondering why I think these lows have been the draw for, a month, 2 months. I mean, I said in September these were the lows. I am using the same concepts I just taught you guys about different market maker models using this one. Okay? A monthly fair value gap is here, IRL. A weekly break of structure. A daily return to that area and a market structure shift. And now I'm framing a daily market maker sell model using my monthly as my higher time frame. So monthly POI. There's a monthly fair value gap up here. Then a weekly structure. Here's the break of structure on the weekly, right down here. Now I'm using a daily market maker model because the retracement on the weekly, look, the retracement on the weekly here was a full daily market maker sell model. And now this retracement on the weekly, look, this retracement on the weekly into what, you ask? Into this weekly fair value gap right here. That return to a weekly fair value gap is a full daily market maker sell model. Do you see it? The buy side of the curve and now the sell side of the curve. Inside the weekly market maker sell model to this level. Boom, brain blown. You can use market maker models on all time frames. I can use market maker models using the 6 month, the 3 month, and the 1 month. I can use it using the 1 hour, the 5 minute, and the 30 second. I just need 3 time frames that give me a higher time frame, an intermediate time frame, and a lower time frame. And I can convince you that every retracement on a higher time frame, like this daily retracement, what was that in our hourly, guys? Remember? Look at the hourly chart. That daily retracement that's highlighted right here, where we eventually broke down, that is just this on the hourly. Look, that's this. That is like if I take this circle, that's this, guys. You can see it, right? That retracement on the daily is just an hourly market maker model. This is the power of using this model, because this model not only teaches you bias, it not only teaches you entries, it not only gives you risk management because it's mechanical, but it also allows you to truly see how the market books on all time frames. This move up is a market maker model, this move down is. It just depends on what time frame you're trading. And I hope today's price action review showed you that even when price looks like this, right? If you have a valid thesis, right? And you don't have to be afraid to long this bearish market if your thesis is valid. Just like you don't have to be afraid to short this high if your 1 hour thesis is valid with this purge. trust your TA, trust the system you have, and then keep a mechanical stop loss rule. So for example, if you were trading this market maker model 1 minute, like I was today, and you wanted a mechanical stop, you would have eventually, before you reached your TP, you would have stopped out, right? This is your entry. You would have stopped out below this low. You would have had a valid re-entry, guys, right here in this fair value gap. You would have said, okay, I'm stopped out here, but now looks like we're forming finally the market maker buy model after digging in a bit more. You would have taken a, how many point loss? 16.25 point loss. Below this low is your stop loss. You would have gotten back in, right? Right here. Here is your first fair value gap after a market structure shift in the 1 minute. There, and then there. That 16-point loss would have been juxtaposed or contrasted with a first take partial 42-point win. That's your first take partial. Then you hold 120 points. So you would have no problem stopping out, re-entering, and following the mechanical system. There you go. That was today's price action. Questions? What is this? The mind-blowing gif. It's funny. Any questions at all? Now's the time to ask. If any of this isn't clear, now is the time to ask. This was not a clear day. Let's be real. This was not an easy day to trade. You need to have a very tactile understanding of your model. If you didn't understand your model and how it books, this could be very jarring to trade. This could be extremely unpleasant to trade. That's why I always tell you guys to favor the higher time frame, right? The hourly model here was quite clean. You gave multiple entries, right? You had a purge here, entry, and a purge here, entry. But there's nothing wrong with trading that 4-hour model. And as I said, now we're heading lower, right? 14,460 is a daily swing low. 14,586 is the weekly swing low. And we have a weekly inefficiency that hasn't been mitigated properly. So if you look at this, we have a shallow raid. So for everyone who's watched my inducement lecture, a shallow raid of this fair value gap right in here on the daily means there's going to be a target for a turtle soup. Just like up here. Shallow raid, turtle soup. Shallow raid, turtle soup. Yeah, no worries, PMA. Yeah, ICT doesn't teach this stuff. This is, like I said, I tell my students, I wish someone taught me the way I'm teaching you, because this makes sense to me, at least, right? Again, if it was taught like this, it would be a lot easier, I think, for a lot of people to make money, but it's not. People, for some reason, it's not taught like this. People are, the way they teach it is arbitrary concepts that you have to combine yourself, where you don't have to. You have all the ICT concepts that I teach are combined here. Every single ICT concept I teach is being combined here in some different way, right? So this is why I like market maker models. They're my preferred poison, but I use all the ICT concepts. I use opening, high, low, close. I use AMD. I use fair value gaps, order blocks, everything. But I'm just using it with a narrative of a framework, a model, which is market maker models. Yeah, no worries, man. No worries at all. Again, if you guys watch my inducement lecture after, we also see what happened with Dixie. Look at this, right? Compare this piece of price action in here to this. Right? Look at this. Now look at this. What do you see? Do you see how we're literally chopping up and down and up and down and up and down above our key level? Let me abstract this away. Compare this price action, which I just traced from the dollar chart, to this. Chopping up and down and up and down and fucking around right above a higher time frame PD array of interest. And look what dollar did today. Came up, came down. Where do you think it's going? If dollar goes up, where does NASDAQ go? Down. Now we have narrative to support higher prices on dollar because we finally broke out of this inducement. Look at this. Just chopping around, finally hit the higher time frame PDRA and discount. This is what we were waiting for. In fact, we could do one more of these. We could come one more time back in like that, and there we go. But finally, we're seeing dollar have the liquidity to move higher because this inducement model has been met. Dollar was unable to come up here and take out this high. It needed to do this. And we pointed this out days ago. Like days ago, we said that dollar is going to do this. So we knew NASDAQ, and some people ask me, how do you know market conditions are going to be choppy? I got that question from like 2 of my students today and a whole bunch of other people. This is how you know conditions are going to be choppy. 2 days ago, I posted this about dollar. Until we see this, conditions are going to be choppy. We're inducing. This is an inducement model that I've taught you guys on dollar. When dollar is inducing, then NASDAQ is inducing. Dollar's finally broken out of the inducement and should see higher prices. Therefore, NASDAQ is finally broken out of its inducement and should see lower prices. That's the question for how do we know it's going to be choppy? Look, read narrative. Look at the structure of the market, right? Okay. Any more questions? Anything at all? It doesn't have to be related to this lecture. It can just be anything. And then I'm going to hop off and sleep. Because I traded London and New York today. And worked. Can you look at the 4 hour? We have a breaker via ICD and 2 targets in the same area. Yeah, let's look at the 4 hour. You're talking about this right here, right? And then you're talking about these stacked PD arrays. You're talking about everything in here, right, Smokey? Yes. Recognize that a 4 hour wick that would take out this level could easily close back below all of these PD arrays. Yes or no? Could a 4 hour wick, remember opening high, low, close. I said I am bearish on the week. I am bullish on the AM session or the morning or the day. Could a 4 hour wick do this? Just the wick. Yes or no? Absolutely. Did I ever think that we were going to push up and be bullish? No. Everything I've said for the past month is we're bearish as hell. We are going down to this level. I've said this for since I took swing options on September 1st, Friday, September 1st, right? I took swing options, monthlies, to this level. And then we raided this level with a tiny little 2 ticks. I'm like, we're going back down to it next week. We have been bearish. We're in a state of bearish delivery. The dollar is in a state of bullish delivery. But the 4 hour could have easily wicked this high and close back within this volume imbalance, close back within this breaker, close back within this SysD or the change in the state of delivery. Because the time frame continuity for a 4 hour retrace, right? This 4 hour retrace is just a daily, or this 4 hour market maker buy model is just a daily retrace. So it could look like something like this up close candle on the day. This up close candle is not bullish. This is a bearish candle, right? This is a order block. Look at the reaction we got off this today. But you can still have up close candles and bearish price action because of higher time frame key levels. Does that make sense? So I was expecting at most 15,223 and then dump. But at the very least, I was expecting to see my 15,109 area, this area right here, my 1 minute market maker model hit. That was my low hanging fruit. That is the 1 minute market maker model that I traded. The extension of that and the 15-minute market maker model was up here. And I was considering the 4 hour could come all the way up and then wick all the way down. Because the hourly, which is based on the daily chart, right, could then put in a purge. Do you see this equal highs on the hourly? So this could, instead of this being the purge, which it was today, this could have been the purge. Is that equally permissible, Smokey? This could have been our purge on the hourly? As opposed to it being this one? Yeah, why not? We have to respect the key level and the structure being put in. So again, playing longs was counter trend 100%, but it was nothing invalid about it. In fact, it was, in my mind, it was more valid because we had a distinct structure being formed on the 15-minute. So I would have loved to see this level being taken out and then a move down. That also would have met my weekly profile, right? That would have accomplished this goal I had. Thursday reversal into Friday sell-off. So that would have been Thursday taking out Tuesday or Wednesday high right here, and then a sell-off. Makes sense, yeah? So essentially what you're saying is like the 4 hour looks bearish as hell. I agree, man. But there's no reason why a bearish 4 hour can't give us a nice run on stops. Right? We look for run on stops in a bearish market. Look at this. Look at these up close days. We look for these up close days to retarget, right? Previous hourly highs, not daily highs. They should be left intact because we're bearish, but look at the hourly highs, right? Look at this. Like, if you don't believe that narrative I just told you, look at hourly highs. Purged. 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 The same logic I'm applying to each of these hourly purges, is it not exactly consistent with the 4 hour narrative I just gave you? Right, so now look at the hourly. That was the, right? If we're bearish, we want to see a change in state of delivery after purges. Well, look at the 4 hour. Key level, a nice 4 hour purge could have been up here, right? We don't know. We have no idea. We cannot predict that. Just like we can't predict where the hourly purge is going to be put in, whether it's going to be this high or this high. All we can do is wait for structure to form, right? We didn't know that this New York would take out all of these highs and come all the way up here. It could have easily only come to here. We didn't know if it was going to take out this high. We didn't know that this New York would take out this London. All we can do is watch structure form and use time frame continuity. Nothing else matters. And that's why the 4 hour was valid. Just for that reason. Swing low, 15-minute break of structure, right in here, and then key level retracement, and there you go. Look at the 15-minute. There's your run on stops. That's what you expect to see, right? 15-minute run on stops there. Let's keep doing this for every day. 15-minute run on stops here. A 4 hour key level potentially. Is there a 4 hour key level here potentially? Let's look. Let's look now, right? Yeah. Look at this, right? Order block, run on stops. The next day, mean threshold, run on stops. The next day, swing low, run on stops. What about here? What is this? What do you see right in here? 4 hour fair value gap, as expected, run on stops. So the 4 hour works the exact same as the hourly because you expect a meaningful revert from a purge and a run on stops if you're in bearish delivery. So today the thesis was that we could reach as high as potentially this high. Could reach here. We didn't know if we would, but we definitely had a run on stops of these highs, which framed this 15-minute market maker model, which framed this 1-minute market maker model, which we traded. All of it comes together. Time frame continuity. All within and contained within the sell model on the hourly, i.e. the daily. All contained within the weekly. Look at the fair value gap. Weekly fair value gap, IRL to ERL. All contained within the monthly. IRL to potentially ERL down here, right? It's all the same. Everything I'm teaching you is the exact same on all time frames. So as long as you get structure, you should respect it. This is all you trade now. Yep. And there's intricacies. This can become more and less complex, right? The more you look into it. But like I said, you can simplify a lot of these things and you can make complex a lot of these things. And depending on your knowledge and how much you want to go down the rabbit hole and how much you want to learn, right? There's levels to it. right? Lots of people have no idea about the complexity of what I'm talking about today, and it might go over the idea of people's heads about, a higher time frame or an intermediate time frame retrace is a lower time frame market maker model. That statement might make no sense to people, but for you it probably makes more sense than it does for someone who has no idea what I'm talking about. And then maybe in a few months, right, you're going to start seeing the stuff I'm talking to you about here, about shallow raids. You're going to start seeing stuff like the inducements you're going to start seeing this kind of stuff, right? Like, it all adds together over time, and then eventually you're just going to become very good at dissecting price action using just one model. Everything I do is one model, but the confluences are all of the ICT shit that we learn. But yeah, valid point. This is a very, very good point. So you should always be considering kind of where the market could draw to. And even on your 4-hour, I'm glad that you noticed, yeah, this is bearish as hell. There's a volume imbalance. There's a breaker, right? There's a series set of up-close candles here that we're trading into, which is an order block. Yeah. All you have to do, though, is look at the 15 and say, is there a possibility to reach into this high? Yes, there is. So let's wait for structure to give us some sort of entry, and let's be very democratic with our partials. Like, our partials are democratic in the sense that we take off 2/3 of our position here, because that's what makes sense to do, especially when you're counter higher time frame trends. All right. Any other questions from anyone else? I'm going to I'll answer any of your questions as well if you want to DM me or reach out. It's all good. If you want to watch the video maybe or kind of try and digest what we've talked about and then come back, that's also good. Yeah, of course, man. It's a pleasure. I'm going to stop the recording.